Hello, welcome. I'm Mitch.Kuhn with NHA, and I'm going to be talking to you today about life settlements, which is how to sell your life insurance policy. So let's get started. So, first of all, what is a life settlement? Simply stated, this is an investor buying a life insurance policy from the policy holder for some type of consideration, most obviously cash. Life insurance policies are considered a legal asset that can be sold just like any other asset, like a home or an investment or a stock or a bond. A life insurance policy is a contract between an insurance company and the policyholder to pay a certain amount of money upon the death of the policyholder. If someone needs money prior to death for any reason, many investors are willing to offer cash in exchange for becoming the beneficiary of the life insurance policy. This all got started back in 1911 when a case went all the way up to the Supreme Court. Dr. Grisby purchased a policy from his patient, John Burchard, for $100 to pay for a necessary surgical operation. So obviously John Burchard needed some money, and so he turned to his doctor friend to buy this policy from him and pay for this necessary operation. Now, there was a lot of controversy in this going through the courts, mostly surrounding the issue of insurable interest. And what the law right now is that if you buy a policy, when the policy is first originally issued, the person who's the beneficiary has to have an insurable interest in the person getting the policy. You have to, either whether it be a family relationship or a business relationship, you have to have some vested interest in that person staying alive. You can't have some stranger buy a policy on you. That's not a legal transaction. So the argument in the court was that changing the beneficiary to someone that does not have an insurable interest is not legal. But as the court reasoned through it, they realized that would diminish the value of the life insurance policy as an asset. Plus, it's not really an issue because it's not originally being issued. This is happening later when the policyholder wants to sell the policy for some valid reason. So now today, it is legal to sell life insurance policies as assets. This became much more popular in the 1980s with the AIDS epidemic. In 1989, late 80s, we started seeing this drastic increase in AIDS, and the life expectancies were very short, typically 24 months or less. So investors were very happy with buying these policies. It was a good profit margin, a quick turnaround. The AIDS patients got the cash they needed, and it was a great deal. Well, as we moved into the 90s, we started seeing better treatments develop for AIDS, which made it very difficult for the investors because the life expectancies became longer and longer, which changed their return on investment dramatically. If you were expecting to get paid your life insurance benefit from this investment you made in 24 months and it turned out to be 48 months or 60 months, it changes all of the economics. So the market really shifted because they couldn't find enough people with terminal illnesses that were living less than 24 months. They tried searching out other diseases, but the demographics were different and the policies just weren't there to be bought. Most people kept them in force. So in the 90s and 2000s, we saw the shift towards life settlements, which was focusing on folks that have longer life expectancies, typically 15 years or less to live. So far more than just the 2 years for viaticals. So now the market is focused on folks that are 65 or older and not necessarily terminally ill. In 2012, there was about $2.12 billion of life insurance face value that was purchased through life settlements. That was about 1,100 transactions. The volume of that was almost 5 times higher, so we had almost 11 billion back around 2009. But as we had the capital available through the banking system dry up, investors didn't have the cash to buy these policies, so we saw the market diminish significantly. And now it's back on the rebound as capital is more available to investors. And we were expecting to see this trend grow as long as the capital is available. Nearly all states have regulations now governing life settlement transactions. There's been recent clarifications about taxation, and even recently in Texas, there has been a law passed in around June of 2013 that now when you're qualifying for Medicaid, it's going to be required that you're told that rather than liquidating your life insurance policy, just turning it in for cash value, that you can actually have this option of selling it to a third party investor and using that money to pay for your care, which would last much longer since you're going to get a higher amount than just getting the cash value. So it just goes to show that the prevalence of life settlements is really growing. Right now, it's not very well known among the majority of people. Most people are only familiar with viatical settlements. So we're definitely seeing a growth in this market. So why would somebody want to sell their policy? Well, first of all, just from an economic standpoint, selling a policy to a third-party investor brings a much higher return than simply turning it in for cash value and surrendering it to the insurance company. So any permanent life policy typically has some level of cash value. It can be very low, it can be high, just depends on the internal mechanics of the policy and how it's funded. But however much the insurance company will give you for the cash surrender value is always going to be less than what you can sell it to a third-party investor for. So just from an economic perspective, it's like if you're going to sell your car, you'd much rather sell it third-party than sell it to the dealership. And that's what this is like. This is selling your car third-party. So many folks need money for medical or living expenses, which was what triggers them to go down this road of thinking about possibly selling their life insurance. It's very common that somebody wants to stay in their own home and receive long-term care assistance or in assisted living facilities. And they're in a particular needy situation because home health care and assisted living is either not covered by Medicaid in most cases or is very, very difficult to qualify for, and there's long waiting lists. So someone can sell their life insurance policy and then get the funds needed in order to pay for that care where they can receive it where they want. Oftentimes, selling a policy can help fund a more effective and different insurance policy. About 1 in 3 settlements create a new life policy or some other type of insurance policy, whether it's more cost-effective life insurance, a long-term care insurance policy, or an annuity. So you can take that money, roll it into an annuity, and turn that lump sum into an income stream that could last your whole life. So if you had another 10 or 12 or 15 years to live, it could be a great way to create a steady income during that period of time. A lot of folks, the premiums simply become unaffordable as they age and the premiums goes up or their income goes down. They can't afford these big life insurance premiums. Or if they have term insurance and there's a conversion option, oftentimes that conversion option is very expensive and the policyholder is simply going to lapse their policy and not take advantage of that conversion option. Well, investors are willing to not only pay the premium to keep the life insurance in force, but also pay the conversion premium in order to make that policy converted and then to buy it and ultimately cash you out. So term insurance can be some of the most valuable policies where you can get a significant sum as opposed to just canceling it and getting nothing. And finally, a major reason is a lot of folks, the reason they bought life insurance no longer exists, whether it was for estate planning purposes, for estate taxes, a spouse passes away, a business venture that there was some life insurance involved that's no longer needed. As the plans change, you can liquidate that asset and free up that cash to do something else with. So here's a couple of real life examples. These names are made up, but these are real situations that we do see take place in the market. So Joan, for example, has developed dementia. She has a whole life policy and the premiums are very difficult for her to afford. She's on a fixed income. Her children can no longer provide the care she needs. Her husband has passed away and she must move to an assisted living facility. She spent most of her savings and she needs more money to pay for her care. She can't qualify for Medicaid because Medicaid doesn't pay for assisted living and she doesn't need nursing home care yet. So she is able to sell her policy, stay in assisted living for a couple of years, and then she can make that transition to Medicaid and the nursing home whenever she does need it. Another example is that Mike has a convertible term policy, but the conversion cost is far more than he can afford. His policy is just going to lapse, and since it's term insurance, there's no cash surrender value at all, so he's just going to get nothing. He can sell his policy for a significant sum rather than lapsing the policy and get nothing. And now he could put that money into an annuity, or he could just use it for living expenses or eventually long-term care expenses. And finally, Susan wants to stay in her own home, but she can't afford home health care, and Medicaid won't pay for it, and Medicare won't pay for it, so she has to pay privately. She has a very valuable universal life policy that she can sell that will fund her stay at home. So as you can see, there's many different reasons why someone could really benefit if they knew that they could sell this valuable asset they have. So who's eligible for a life settlement? Who can sell their policy? Well, investors are typically willing to buy a policy from someone who has 15 years or less to live. Typically age 65 and 70 or older is what most investors are looking for. All of them have their own little niche markets that they like. So it just depends. The shorter the life expectancy in general, the more money the policy is worth because the investors will get their return on investment sooner. The longer they have to pay those, because the investors are going to start paying the premiums like they own the policy. So the longer they pay premiums, that eats into their return on investment. You can sell permanent life insurance, including whole and universal life. Investors do not want to buy variable life insurance policies in most instances. Term life policies can also be sold under the right conditions. It just depends on the specifics of those policies, but term can be sold. As far as the size of face values, most investors are looking for actually $250,000 and up is the largest percentage of the market. There's many investors that will buy policies as small as $100,000. It is a smaller market there. And then there's a very few handful of investors that will go down as small as $50,000. But for those policies, there's specific criteria and there's just less options out there. But it certainly is available. In most cases, policies need to be enforced for 2 years or longer. The one thing to watch out for is what's called stollies. These are stranger-originated life insurance. So what happens sometimes is an agent will approach an elderly person and get them to buy, let's say, $1 million policy they can't afford, and the agent will offer to loan them the money to pay the premiums, and then the agent will want to immediately turn around and sell that life insurance policy to a third-party investor to make that return. So that is something that is not legal. It's obviously frowned upon and is being more highly regulated now. So if anyone tries to talk you into setting up separate entities to own these life policies, to buy policies more than you can afford, or to loan you money for premiums, tuck tail and run. That is not a good or a legal situation. So who actually buys these life insurance policies? Well, life insurance policies are purchased by licensed life settlement providers. These are companies who determine the price that should be paid for any given life policy. And then they buy the policy from you. It's a relatively small market. There's around 40 or 50 licensed providers. There's around 80 or 90 licensed providers in the US. Only about half of those are working in more than 2 states. So it's still a relatively small market. Life settlement providers work with investors who provide the capital needed to purchase the life policies. A life settlement provider will buy the policy from you, but an investor may end up owning the policy. In some cases, the provider can also be the investor if they provide their own capital. So let's say, for example, there's, just make up a name, Magnum Capital is going to buy your life insurance policy as the provider. Magnum Capital may have 10 or 12 or a dozen other investors providing the cash that they're using to buy those policies. Or in some cases, providers are self-funded. A life settlement broker will prepare a proposal to send to many different providers to obtain offers. So a broker goes to many providers and shops the market and then presents you with the best offer to assist in the transaction. Now, you're likely going to work with an agent who represents a life settlement broker. So the agent will be your personal contact. They'll help you fill out the application. They'll send that off to the broker. The broker will go shop the market of providers, and then the providers will send back the offers to the agent, who will then present it to you, the client. So those are all the different steps in the process. So how much are you going to get for your policy? Well, it really depends on a number of different factors. First of all, there's age. Typically, older ages bring higher settlements because typically the life expectancy is less. And regarding health, the worse your health, the larger the settlement because, again, the quicker the return on investment for the person buying the policy or the entity buying the policy. Also, the type of policy can determine how much it's worth, whether it's universal, whole, term life. So under the right conditions, term insurance can bring the largest settlement because the premiums tend to be the lowest. So if you think about an investor buying this, he's going to have to put up front, let's say $50,000 to buy your $100,000 life policy, but then they got to pay the premiums every year for as long as you live. So the lower the premiums, the better the return, the more money you're going to get. We already covered premiums. Now, it is important to get multiple offers from different providers to make sure you're getting the highest settlement possible. If you work with a good life settlement broker, they'll ensure that a competitive bidding process is conducted. It's a fairly small market, so most good brokers can get to the majority of the market and make sure you've got a competitive bid. There can be cases where if you're in a severe time crunch, that there are certain providers that can provide funding very quickly without shopping the market. So that is an option. You're just not going to be able to sample all the different options out there. So here are some sample life settlements to give you an idea of how these settlements pay out. So here's a convertible term policy that was a $250,000 face amount. This is a 72-year-old male. The conversion premium was $9,300 per year. So the owner got $27,500 in cash after all the expenses and transaction fees and everything that has to take place. So you can see this $250,000 term policy was just going to lapse. It was going to be worth nothing. And instead, he got $30,000. Now, here's an example of a permanent policy. This is a $1 million face amount, an 82-year-old female. The surrender value is $23,000. So if she just stopped paying her premiums, she was going to get $23,000. Her annual premium is $30,000. So obviously, if she pays just one more year of premium, she's spent more than what the cash value is worth. So this policy was sold, and she was able to get $200,000 for that policy. You can see considerably more than that $23,000 cash surrender value, 10 times more. Here's a smaller permanent policy, a $100,000 policy for an 84-year-old male. There was no surrender value. There wasn't any cash value in this policy the way it worked out. It was an average or annual premium of $3,500. He was able to get $20,000 out of this policy, whereas the surrender value was nothing. And then here's a fourth option. Sometimes when you have larger face amounts, you can actually sell just a part of your insurance and not sell all of it. So here's a $1.5 million face amount. It's an 83-year-old male. The surrender value is $20,000. The annual premium is $120,000. Obviously, very difficult to afford. So what happened here was the investor was willing to pay $50,000 upfront cash. They assumed the annual premium payments, and the policy owner, the person who's selling it, was still able to receive, if they died within the next 4 years, a $600,000 benefit. And if they die 5 years or later, a $200,000 death benefit. So larger policies can be split up and you can sell a portion of that. It's called a retained death benefit settlement. And again, these are just samples. We can see numbers higher than this. We can see lower. It just depends on the details of the policy and the seller's health. So how long does it take to sell a policy? The first step is you got to get offers. You're going to have to fill out an application, which is fairly simple. The company is going to request medical records, which is typically the biggest delay, is getting the doctors to release those records. Then there's a possible third-party life expectancy estimate, which is going to be a big part of providing that to the investors so they can determine what this is worth. And then the providers are going to make offers. This process can take anywhere from 1 to 3 months, just depending on a number of different factors, or possibly longer. Step 2 is review the offers. So once the offers come back in, your agent will sit down with you and help you understand what you're looking at and decide what you want to accept. And then step 3 is you're going to do the transaction, which could take anywhere from 2 to 4 weeks, just depending on how quickly you make decisions and get the paperwork done. So this is a very safe, secure process, much like selling a home. The money is placed into an escrow account, and then the money is released when the beneficiary change is completed. So you'll submit a form to the insurance company that changes the beneficiary from whoever it was to the new investor who's bought it. And once they get that confirmation, they'll notify escrow and you'll receive your money. So the total time could be anywhere from 6 weeks to 4 months if the seller is holding up the process, if medical records are very slow, it could drag out longer. But if you're motivated and in a hurry and doing everything you should, you can get this done in 6 weeks to 4 months. And again, there are options where you could do this in 30 days. But again, you're only going to be going to one provider and there's more limitations. But if you're in a crunch trying to pay for care, there are definitely options to do that. So how are life settlements taxed? Well, if it's a viatical settlement, which is 24 months or less to live, then there's no taxes. Those are tax-free. But life settlements, which is 25 months or longer to live, are taxed. And here's how it works out. So first of all, you start off with your cash value, which is how much if you surrendered the policy today and just gave it back to the insurance company, they're going to give you this amount of money. So let's say hypothetically it's $30,000. Then you subtract the total cost of all the premiums you've paid minus the cost of the insurance. Now, cost of insurance is when you pay your premium in a permanent policy, part of it is covering just the insurance cost, just to keep that death benefit in place. And then part of it is excess that builds up the cash value. So from a regulation standpoint, from a tax standpoint, the IRS says that, well, that money you paid to keep the insurance just in force, the cost of insurance, is not deductible. That's not your investment. You've already consumed that. You've received the benefit of that by having insurance in force. So that $5,000, for example, you can't take out of your investment. So here we take the cash value minus the premiums paid, less the cost of insurance, and we get a $25,000 difference there. Now that difference is going to be taxed as ordinary income. So whatever your tax bracket is, hypothetically put 25% here. So you're going to owe $6,250 out of that settlement. The next portion is going to be the difference between your settlement and your cash value. So we have a $150,000 face value, a $60,000 settlement, which you were paid for this policy. The difference is $30,000 between that and the cash value. That $30,000 is taxed as capital gains. So hypothetically, 15%, it's a $4,500 capital gains tax bill. So you had your $60,000 settlement, you paid $4,500 in capital gains, you paid $6,250 in income tax. So after all the taxes, you got $49,250. So let's cover a couple common misconceptions about life settlements. Life settlements have gotten a bit of a bad rap in some ways. People saying they're risky or there's a lot of fraud going on with them. Well, the truth is that selling a life insurance policy is very different than being the investor and buying them. Most of the fraud and the bad stories you've heard about have taken place on the investor side, not those selling the policies. When you sell the policy, your money goes in escrow, you get your cash, they get the policy, you walk away, and you never have to deal with them again. So it's a very safe, regulated, pretty simple transaction. Now, the investors is much more difficult because how much money they're going to make really depends on the life expectancy of that person and the evaluation of that policy. So what happened on the investor market was life expectancies really weren't as accurate as they could have been in the 90s and the 2000s for a variety of different reasons. You know, a lot of medical conditions, we've developed better treatments and people were living longer. They were living with cancer and AIDS and heart disease and all kinds of things that used to cause shorter life expectancies. So there's been a reshuffling, a rethinking of the life expectancies to help make this more accurate for the investors. The second common misconception is that life settlements are complicated. Again, from the seller's standpoint, this is very simple. All they need is a basic application. They're going to request medical records. They may call you on the phone or do a little phone interview, and then they're going to make an offer. And all you have to do is accept or reject the offer. Money goes to an escrow, and then you're done. Where they are complicated is more on the investor side. So if you're considering investing in these, there's a lot more research to be done about how to get a good return. The other misconception is that you can only sell large permanent policies. The market in the past has been $500,000 and up. I mean, the average policy sold today is still, closer to $1 million policy, $1 million face value. But more recently, with more investors coming in the market, more capital available, and also the recognition that there's a lot of people out there with $50,000 and $100,000 policies that really need to sell these things, that market is expanding. So now you can sell policies as small as $100,000 with a good number of providers, and then a very select providers will provide purchases of policies as low as $50,000. So that's an overview of life settlements and how to sell your life insurance. So feel free to contact me if you have questions. I can help you decide if this is something you want to look into. My name is Mitch.Kuhn, and my number and email address are right here on the page. So thank you very much for listening. Have a great day.